Welcome. We're here today to talk about something really important for any growing business in the UK, quarterly payments for corporation tax. Your success is something to celebrate for sure, but it also opens up a whole new level of responsibilities. That's why we've teamed up with the absolute experts at ProTax Accountant to break it all down for you.
So let's get right to it. Is your business success actually about to trigger a massive tax headache? You've put in the hours, the profits are finally climbing, business is great, but that very success might just be about to push you into a completely new and way more complicated tax bracket. It's a critical question to ask.
Now, navigating this stuff can seriously feel like you're trying to find your way through a maze, blindfolded. But don't worry, this whole guide has been put together by the tax specialists at ProTax Accountant to give you a clear, straightforward path.
So here's what we're going to cover. First, we'll get into what these quarterly payments actually are. Then, the big one, who has to pay them? We'll look at the payment schedule, the painful cost of getting it wrong, and of course, how you can manage it all and get the right help.
Okay, Section 1. What are we actually talking about with these quarterly payments? Well, if you're used to paying your corporation tax bill in one single lump sum way after your business year has ended, things are about to change. As your company grows, so do your obligations to HMRC.
At its heart, the system is called Quarterly Installment Payments, or QIPs for short, and it's pretty much what it says on the tin. Instead of that one big payment, HMRC wants large companies to pay their corporation tax in 4 chunks. It's a fundamental shift, really, from paying based on what happened last year to paying based on what's happening right now. And that brings us to the million-dollar question, or, the £1.5 million question in this case. Who actually has to do this? This is probably the most important part of our chat today, because once you cross this line, the way you handle your tax compliance changes completely.
Here it is, the main number to remember, £1.5 million. If your company's annual taxable profits hit that number, congratulations. HMRC now considers you a large company. But, and this is a huge but, it's almost never that simple. Stay with me, because this next point is the trap that catches so many people out.
So what happens if you're a serial entrepreneur? Maybe you have your main trading company, but also a holding company and maybe another one that owns some property. Does that £1.5 million figure still hold up? The short answer, nope. And this is a major tripwire.
Let's talk about something called the associated company rule. It's a crucial concept. Put simply, if you control more than one company, or if you and a partner control a few companies together, HMRC sees them all as being associated. And get this even includes any companies you have overseas. The net is cast very wide here.
And this table shows the impact perfectly. You take that big £1.5 million threshold and you have to divide it by the total number of companies in your group. So in this example, you have your main company plus 5 others you control. That's 6 in total. All of a sudden, that threshold plummets from £1.5 million all the way down to just £250,000. That is a massive difference.
Okay, here's a little pro tip for you. Generally, HMRC gives you a bit of a break. The first year your profits cross that threshold, you get a grace period. You don't have to start paying in installments right away. But you've got to be careful. There's a catch. If your profits don't just creep over the line, but absolutely smash through £10 million, again, divided by your associated companies, that grace period just vanishes. You're in the system immediately.
Right, so you figured out you're officially a large company. What's next? The obvious question is, when do I actually have to pay this money? Let's get into the practical side of things. This is where you might want to get your calendar ready.
The days you need to know depend on just how big you are. For large companies, the payments are due in the 7th and 10th month of your financial year, and then the 13th and 16th months. But if your profits go over £20 million, you're now classed as very large, and the whole timeline speeds up. Your payments are due much earlier, all within the financial year itself.
Let's make this real with an example. Say your financial year starts on January 1st, 2026. Your first payment isn't due until mid-July. The second is in October. But look at the third one, January 14th, 2027. That's just 2 weeks after your year has actually ended. Then the final payment is in April. Seeing it laid out like this really helps you plan your cash flow.
But that's not all. Here's where things can go really wrong. Knowing the dates is one thing. Understanding the consequences of missing them or underpaying is a whole different ballgame. The financial penalties can be pretty brutal, so you'll want to pay close attention here. Take a look at that number, 7.75%. That's the interest rate HMRC is currently charging on any late or underpaid tax.
I mean, just let that sink in. This isn't your standard bank rate. It's a punitive charge designed to make sure you pay on time, and it can add up incredibly fast.
And that interest is just the beginning. Even though you can claim it as a business expense, it's still cash flowing out of your business that you can't use for growth. Even worse, if HMRC thinks you deliberately messed up, they can slap you with extra penalties. And maybe worst of all, it puts a giant red flag next to your company's name, which could lead to a full-blown tax audit. And nobody wants that.
Okay, we've seen the risks, so how do you actually stay on top of all this? The key, really, is to get proactive. This isn't just about paying a bill anymore. It's about actively managing your finances all year round. Here's how the process works. First, you have to estimate your total tax bill for the year you are currently in. That's the hard part. You're basically forecasting the future. Then you calculate your 4 payments based on that. But it doesn't end there. Step 3 is absolutely crucial. You have to keep reviewing that forecast. If business suddenly booms, your estimate needs to change, and you should top up your tax payments. It's a living, breathing process.
And here's another fantastic tip for anyone running multiple companies. Did you know you can set up what's called a group payment arrangement, or GPA? It lets you make one single payment for all your associated companies combined. It makes the admin so much easier and can really help you manage your cash flow and interest charges across the whole group. It's a brilliant tool.
Which brings us to our final section. We've covered a lot, and it's pretty clear that this is a complicated area of tax. And while it's great to understand the basics, trying to handle all this yourself while also, running a growing business, that's a huge risk to take.
So let's just do a quick recap of the absolute key takeaways. QIPs kick in when profits go over $1.5 million. But remember that associated companies rule can bring that number way, way down. The payment dates are spread out and require careful planning. Get it wrong and you're looking at hefty interest charges. And most importantly, everything is based on an estimate which you need to constantly review.
If any of this sounds familiar, or you think your business is getting close to that threshold, the smartest thing you can do is talk to an expert. The team at ProTax Accountant lives and breathes this stuff. You can reach them directly on WhatsApp or by phone at 07985-689912, or just drop them an email at info@protaxaccountant.co.uk. They've also got loads more detail on their blog, and it really recommends subscribing to their YouTube channel too.
So we'll leave you with one final thought to chew on. Is your financial strategy truly ready for the next stage of your company's growth? Getting a handle on QIPs is a massive part of that. And just a quick, important disclaimer, the information we've gone over today is for general guidance only. Every business is unique, so before you make any financial decisions, you absolutely must speak with a qualified tax expert like the fantastic team at ProTax Accountant. Thanks for watching.